Have you ever felt like the global economy is standing on the edge of something monumental, financially speaking?
Mm.
Like there are powerful unseen forces at play, fundamentally reshaping our future.
Yeah, definitely.
If that feeling resonates with you, you're absolutely not alone. Today, we're going to unpack why that intuition might be far more accurate than you realize.
Indeed. The Bank for International Settlements, the body often referred to as the central banker's central bank,
Hmm,
owned by 63 central banks, including those in China and the United States, has just released its annual economic report for 2025.
right.
It's a remarkably comprehensive assessment of the global economic landscape, and their overarching message is stark.
Hmm.
We're truly at a pivotal moment.
That's a powerful phrase, pivotal moment. For this deep dive, we've gone deep into their latest reports and analyses, pulling insights from major outlets like Reuters and the South China Morning Post, digging into financial feeds, and even directly from transcripts of the BIS's own YouTube
There's
discussions.
a lot of material there.
Definitely. Our mission, as always, is to cut through the dense financial jargon and distill all this information into something you can quickly grasp, something that gives you those aha moments.
Making sense of it all.
Exactly. We want you to feel genuinely well informed about the seismic shifts happening in the global economy right now. So, as we navigate these complexities, I invite you to think about what stands out most to you. So, let's really lean into this pivotal moment the BIS describes. They are sugarcoating it. They're painting a picture of heightened uncertainty and unpredictability.
Hmm.
Augustine Carstens, the outgoing head of the BIS, even stated that the global economy is entering a new era.
A whole new era. That's quite a statement.
It feels like a significant shift from where we were just a short while ago when everyone was talking about a comfortable soft landing for the economy. Remember that.
Oh yeah, the soft landing narrative was everywhere.
Now that optimism seems to have vanished, replaced by what the reports bluntly call turbulence and uncertainty.
And what's particularly striking here isn't just the acknowledgement of uncertainty, but how concretely it's linked to real-world financial and geopolitical events.
Right.
The report, for example, was published just a week before a critical U.S. trade tariff deadline. And, on the heels of 6 months of intense global upheaval.
So, very current events feeding into this.
Exactly. Think of the global economy not as a finely tuned machine, but maybe like a colossal container ship.
Right.
For years, this ship navigated relatively calm, predictable waters, aiming for that gentle, soft landing into a safe harbor.
Right, smooth sailing.
But the BIS is now sounding the alarm.
Mm.
We've clearly sailed into a storm. The winds are unpredictable, currents are strong and shifting, and the destination, once clear, is now kind of obscured by fog.
That's a vivid image.
And this isn't just abstract economic theory. This pervasive uncertainty fundamentally impacts real-world decisions that affect your wallet. Businesses might delay crucial investments because they're unsure about future trade barriers or how supply chains will hold up.
Makes sense. Why commit if you don't know the rules?
Precisely. And for households, this can mean hesitating on big purchases like a new car or a home simply because job security feels less certain or interest rates are swinging wildly. This new era permeates every level of economic activity.
It's a powerful image, a ship in a storm. And it suggests this isn't just a vague feeling, it's an observable reality, identified by the very highest echelons of global finance. This brings us to what the BIS refers to as deep fault lines. What exactly are these fundamental cracks appearing in the global economic structure?
Well, if we connect this to the bigger picture, one of the most critical fault lines the BIS highlights is a dual challenge: the erosion of public trust in institutions, including central banks, and accelerating economic fragmentation.
Okay, trust and fragmentation. Let's take trust first.
The report explicitly underscores rising uncertainties, declining trust in institutions. This is a profound concern because trust is the absolute bedrock of any stable financial system.
Without trust, the whole thing wobbles.
Exactly. Augustine Carstens noted that this new era is specifically testing public trust in institutions, including central banks, precisely because these institutions have been grappling with stubbornly high inflation.
People see prices going up and wonder if the banks have lost control.
That's the core of it. The crucial insight here is that if people lose faith in their central bank's ability to keep prices steady, if their inflation expectations become unmoored, like, a ship losing its anchor, they start making financial decisions that actually drive more inflation.
Yeah, how so?
Like demanding higher wages or spending money faster before it loses more value. It becomes a self-fulfilling, dangerous prophecy that makes monetary policy far less effective.
So it's not just about the numbers, it's about the psychology. If you expect prices to keep rising, you act in ways that can make it happen.
Precisely. It's a feedback loop.
And then there's the fragmentation piece. We're seeing trade tensions and geopolitical skirmishes creating these deep fault lines. How does that impact our day-to-day lives?
Oh, it impacts us profoundly. The BIS warns that protectionist policies and fragmented trade relations could exacerbate economic inequality and disrupt cross-border financial flows.
So hitting both fairness and the flow of money.
Right. And this accelerating shift towards fragmentation and protectionism is even accelerating the decline in productivity growth, which is bad for long-term living standards.
Can you give an example?
Sure. To give you a concrete example from the source material, we saw significant U.S. tariffs on Canada and Mexico, followed by broad-based tariffs on U.S. imports from all trading partners, culminating in peak tariffs as high as 145% on most U.S. imports from China.
Wow, 145%.
Yeah, huge numbers. This isn't just about political headlines. It means the global supply chains, built over decades for maximum efficiency, are now being fractured.
Broken up.
Exactly. For you, the listener, this can translate directly into goods becoming more expensive or less available, as companies struggle to reroute production and find less efficient, but perhaps politically safer, supply lines.
More hassle, more cost.
It creates frequent reversals and legal challenges, essentially adding immense friction to the once smooth gears of international trade.
That's a massive reversal from the globalization trend we've known for so long.
It really is.
And it brings us directly to one of the most immediate and tangible impacts of this global crossroads,
Yeah.
the relentless pressure of inflation. It feels like we've been talking about inflation for years now.
Seems like it, yeah.
But the BIS report suggests it's leaving a permanent mark on how households perceive prices.
This raises an important question, doesn't it? Have your inflation expectations been shaped by the last few years?
I'd guess for most people, yes.
The BIS survey says, likely yes. The report highlights that persistent inflation has forced central banks to maintain tighter interest rates.
Which we're all feeling.
Right. This, in turn, has squeezed leverage in key sectors such as banking, real estate, and private credit, increasing market stress.
Leverage being squeezed, meaning borrowing is harder, more expensive.
Exactly. The era of persistently low interest rates and abundant liquidity, which defines so much of the post-2008 financial landscape, is definitively over.
That's a big statement. Over.
It is. For you, this is the new reality of tighter monetary policy. It means higher borrowing costs for mortgages, car loans, business investments, pretty much everything.
And central banks are caught in a tough spot.
They're navigating an incredibly delicate balance, especially with global supply chain disruptions and these new trade barriers, making it harder to control prices using just interest rates. It's not as simple as just hiking rates anymore.
And the data from the BIS survey on this perception gap is quite striking, isn't it?
It really is. A March-April 2025 survey found that average household inflation expectations for the next 12 months were around 8%.
8%, when actual inflation was.
Significantly lower, around 2.4% average at the time. That's a huge gap.
A massive disconnect.
And even more concerning, 20% of the population perceived price increases above 30% for the period of 2020 to 2024.
30%. That shows how lived experience can diverge from the official stats.
It's a critical disconnect, and it highlights the challenge. When people believe inflation is that high, their behavior shifts. They might demand higher wages or spend faster to beat rising prices, which can then feed into actual inflation. It becomes a psychological battle, too.
So perception can become reality.
To some extent, yes. The survey also found something interesting. Awareness of central banks and their price stability goals correlates with lower inflation expectations.
So communication matters. A lot.
Hugely. It really underscores the importance of clear, transparent communication from these institutions. This permanent mark on household expectations means central banks face an uphill battle. They not only need to control current inflation, but also to reshape deep-seated public perceptions that have been scarred by the recent surge.
Managing psychology as much as economics.
You got it.
And speaking of monumental challenges, governments are facing their own uphill battles, particularly with ballooning debt. The BIS is sounding a loud alarm about public debt, calling it a looming crisis.
It's a very serious warning. The core message is that high and rising public debt is increasing the financial system's vulnerability to interest rate changes.
Making everything more sensitive to rate hikes.
And reducing government's ability to spend their way out of crises.
Less room to maneuver when things go wrong.
Exactly. Augustin Carstens bluntly declared, This trend cannot continue. This is especially concerning because debt levels are at historic peacetime highs globally and are projected to rise further.
Why? What's driving it?
It's a powerful mix of forces. Aging populations driving up healthcare and pension costs, the massive need for infrastructure investment, the global green energy transition, and even increased defense spending in some places.
So it's not just about the debts accumulated from the past, but the growing mountain of future obligations.
Precisely. The report highlights that interest payments in many developed countries have jumped dramatically.
Eating up more of the budget.
Right. Now eating up over 4% of their entire economic output, up from 3% just a few years ago. Imagine a significant chunk of your government's budget just vanishing, going purely to pay interest on old debts.
Leaves less for everything else.
And furthermore, many countries are set to refinance up to half their public debt stock within the next 2 years.
Rolling over debt at potentially higher rates.
That's the risk. This is the trap many governments are falling into. High debt levels now leave very little room to respond to future crises. It limits their ability to support the economy during downturns or invest in critical areas like education or infrastructure that could boost future growth.
So how does this affect the average person, you listening?
Well, for you, the taxpayer, it means a larger portion of government revenue is diverted away from funding new programs and services, solely to service this ever-growing interest bill. Less fiscal space means fewer options for government support or investment.
That's a stark picture. And we've seen this play out in the markets recently, haven't we? Episodes of stress.
We have. The report cites the UK gilt market turmoil in September 2022
I remember that.
and the U.S. regional banking crisis in March 2023 as prime examples where bond losses were central and unrealized losses on government bonds became a critical issue due to rapid interest rate increases.
Because rising rates make existing bonds worth less.
Exactly. These aren't isolated incidents. They are stark symptoms of a financial system that is now incredibly sensitive to interest rate changes. Precisely because debt levels are so high, it's a dangerous feedback loop.
Explain that loop.
Rising rates stress government finances, which then stresses the financial institutions holding government bonds, like banks or pension funds. And if those institutions get into trouble, it can send shockwaves through the broader economy, potentially further eroding the government's creditworthiness. It's a very precarious position to be in.
Very interconnected. So if the economy itself is at a crossroads, the very financial system that underpins it all is also undergoing profound and sometimes unsettling shifts. The BIS report pivots now to a crucial, often overlooked part of that world: non-bank financial institutions. Okay, NBFIs. The BIS highlights non-bank financial institutions, or NBFIs, as a major focal point of their report. We're talking about entities like private equity firms, hedge funds, pension funds, insurance companies.
The so-called shadow banking sector, although the BIS prefers NBFI.
Right. They've grown significantly, and what's particularly concerning, according to the report, is that they're introducing new risks precisely because they often operate with less regulatory oversight than traditional banks.
The key distinction, absolutely. While traditional banks are heavily regulated post-financial crisis, NBFIs often operate with less regulatory oversight, making them vulnerable to liquidity shocks and amplifying systemic risks.
Vulnerable to shocks and can make things worse for everyone else.
Potentially, yes. Hyun-Song Shin, the BIS economic advisor, used a really vivid analogy describing the modern monetary and financial system with its increased interconnectedness as resembling an accident waiting to happen.
Wow, an accident waiting to happen. That's strong language.
It is. This shift of financial intermediation away from banks and, crucially, towards financing public debt has heightened liquidity risks in bond markets.
Why is this shift happening?
Well, part of it is the ongoing search for yield in a world of low returns from traditional investments. Investors looking for better returns.
Sure.
Part of it is also regulatory arbitrage moving activities to areas with lighter oversight to avoid stricter bank rules.
Finding loopholes.
Essentially. But the real concern is that it creates a potent mix of risk. Massive amounts of capital flowing through entities that simply don't have the same capital buffers, liquidity requirements, or crisis management frameworks that traditional banks do.
So less of a safety net.
And less transparency. This opacity means that by the time a problem becomes visible, it might already be large enough to cause significant disruption across the entire system.
An accident waiting to happen? That's a pretty strong phrase coming from a central banker. So within this evolving landscape, some specific areas are raising even louder alarm bells due to their sheer scale and opacity.
Mm.
We're talking about the shadowy world of FX swaps and repo markets.
This is where the sheer scale becomes truly staggering, almost mind-boggling. The foreign exchange, or FX swap market alone, reached an astounding $111 trillion at the end of 2024.
111 trillion.
Trillion, with a T. To put that into perspective, it far surpasses cross-border bank claims, $40 trillion, and international bonds, $29 trillion.
So this market is way bigger than international banking and bonds combined.
Way bigger. We're talking about a hidden market that trades in tens of trillions of dollars annually, a scale so immense it dwarfs what passes through traditional channels.
And why is it risky?
What's truly critical is that nearly 90% of these swaps involve the US dollar,
Okay, dollar dominance again.
and more than three-quarters mature in less than a year. This creates massive liquidity mismatches and rollover risks.
Explain rollover risk in this context.
Think of it like this. Many non-US investors hold US assets, like treasuries. To protect themselves against the dollar moving against them, they use these short-term FX swaps. It's a hedge.
Makes sense.
But if for any reason they can't roll over, these short-term contracts essentially renew them when they expire. They might face a sudden, urgent demand for dollars they don't immediately have.
A funding crunch.
Exactly. This could force them to sell their U.S. assets, like treasuries, rapidly, potentially triggering a cascade of selling through the market, a fire sale.
Which could destabilize things very quickly.
Very quickly.
And then there's the repo market, which is where hedge funds get most of their financing. The report mentions zero haircut. That sounds incredibly risky. Can you break that down for us?
Zero haircut is indeed dangerous, and it's a key source of fragility identified by the BIS. It means that when a hedge fund borrows cash by pledging government securities, say U.S. treasuries, as collateral,
Standard practice.
the lender gives them the full market value of that collateral, or sometimes even more. There's no margin of safety, no haircut for the lender if the value of the collateral drops suddenly.
So no buffer if the bond price falls.
None. This allows hedge funds to deploy enormous leverage, borrowing huge amounts relative to their own capital. The BIS warns that this system has much of the fragility of traditional banking, but even less transparency.
Fragile like banks, but harder to see what's going on.
Exactly. And consider this statistic. Hedge funds' gross exposure to U.S. government debt now exceeds 10% of the outstanding free float.
10% of the available market is held or leveraged by hedge funds.
Gross exposure, yes. This creates a situation where the financial system becomes highly sensitive to small shifts, like a house of cards. We saw this vulnerability surface clearly in September 2019 and March 2020 during moments of market stress related to these very repo market linkages.
Right, those repo market scares.
And furthermore, the sharp fall in the dollar we've seen, down 10% in 6 months, as Reuters noted, is partly influenced by these non-U.S. investors hedging their dollar exposures using those FX swaps.
So it all connects?
It all connects. If they become increasingly uncomfortable holding dollar assets, their hedging activities can contribute to dollar weakness, which then has further ripple effects globally. It's like a quiet, immense engine of risk humming beneath the surface of the financial system.
So these hidden massive markets can have very real cascading consequences, even if you're not directly involved. It's a clear, interconnected web of risks. Now, let's pivot to something many of you might be hearing more about in headlines. The intersection of technology and this complex financial world, specifically tokenization and stablecoins. Okay, let's turn our attention to the future of money itself. The BIS sees immense potential in what they call tokenization. It sounds a bit technical, but the core message is that it offers transformative potential for efficiency in financial transactions.
Big potential, yes.
And could lay the groundwork for the next generation monetary and financial system.
Tokenization, at its heart, refers to the digital representation of claims on a programmable platform. Think of it this way. Instead of a physical document, a stock certificate, or even a traditional digital entry in a ledger, you have a digital token, maybe on a blockchain or similar technology.
Okay, a digital token representing something real.
Right. But what's revolutionary isn't just its digital nature, it's that this token doesn't merely represent an asset, it also incorporates the rules and logic governing transfers.
Ah, the rules are embedded in the token.
Exactly. This means it enables the integration of messaging, reconciliation, and asset transfers into a single, seamless operation. The aha moment here is the radical streamlining of finance.
How so?
Instead of multiple steps and intermediaries for a transaction to clear and settle, which adds cost, time, and potential for error tokenization, could combine all of that into one seamless, almost instantaneous process on what they call a unified ledger.
So if you're trying to transfer ownership of an asset or even just make a payment, it's not just faster, but potentially cheaper because you're cutting out so many steps and reducing errors.
Precisely. That's the promise. The BIS proposes a unified platform for a trilogy of tokenized central bank reserves, commercial bank deposits, and government bonds.
Bringing different core assets onto one type of platform.
Yes, they even point to Project Promesa, a BIS initiative that successfully demonstrated the feasibility of tokenizing promissory notes for multilateral development banks. This could significantly reduce costs and friction for central banks and ministries of finance in their own operations.
Interesting. So real-world testing.
Yeah. Imagine taking a complex legal document or a financial contract, digitizing it, and then building all the legal and transactional rules directly into the digital document itself, automatically executing them when conditions are met. That's the vision for efficiency and cost reduction that tokenization offers.
And how might that benefit the listener, you?
Potentially, in the future, through reduced transaction fees, faster access to funds, or more transparent dealings in things like real estate or investments.
Okay, so tokenization has a lot of promise, according to the BIS. But then there's another digital asset, stablecoins, which comes with significant warnings.
A very different tone, yes.
Despite their name, stablecoin, the BIS is pretty cautious, suggesting they may only play a subsidiary role in the future of money. Why the caution?
Yes, the BIS warns that stablecoins lack key characteristics held by the currencies on which they are backed. Stablecoins, as you know, aim to combine the efficiency of cryptocurrencies with the stability of traditional money, typically by being backed one-to-one by fiat currencies like the US dollar.
Trying to be the best of both worlds.
Right. However, the BIS argues that a sound monetary system requires three crucial features: singleness of money, elasticity, and safeguarding the integrity of the system against financial crime.
Okay, singleness, elasticity, integrity. What do those mean here?
The report states that stablecoins do less well on these vital aspects. Singleness of money implies one universally accepted, trusted currency issued by a central authority, like the dollar or the euro. Stablecoins, while aiming for stability, are still private instruments and introduce fragmentation, multiple types of dollars, potentially.
Okay, and elasticity.
Elasticity refers to the ability of the money supply to expand or contract as needed in response to economic conditions, which a central bank can manage systemically to fight recessions or inflation. Private stablecoin issuers can't really do that in the same broad, crisis-averting way.
Their scope is limited,
Right.
and then there's the integrity part, which sounds like it has to do with illicit activities.
That's a major concern, and a significant warning from the BIS. They caution that stablecoins rely on the pseudonymity of public blockchains to circulate without issuer oversight,
Meaning it's hard to know who's using them.
and therefore become the go-to choice for illicit use to bypass integrity safeguards. Think money laundering, terrorist financing.
Not good. How does that impact the broader system?
It directly impacts the broader financial system that you rely on, because illicit finance undermines trust, can destabilize legitimate markets, and complicates global efforts to combat financial crime.
And there are other stability concerns too.
Yes. Furthermore, some major stablecoin issuers like Tether and Circle hold significant reserves in U.S. Treasuries and provide substantial repo market funding. Remember the repo market?
We just talked about it, very interconnected.
Exactly. This raises financial stability concerns because it creates a direct link, exposing traditional finance to the ebbs and flows of the crypto ecosystem.
So problems in crypto could spill over into core markets.
That's the worry. Imagine a sudden run on a large stablecoin. It could be forced to liquidate its treasury holdings rapidly, creating significant stress in a critical market that underpins the entire financial system.
That sounds potentially very destabilizing.
It does. So the warning about their subsidiary role is a clear signal from the BIS. They firmly believe traditional central bank issued money will maintain its primacy, with stablecoins existing only on the periphery if properly regulated.
A clear hierarchy there. Now, beyond stablecoins, the report also touches on another massive technological shift: artificial intelligence.
Ah, yes, AI.
It feels like AI is everywhere, impacting everything, and the BIS acknowledges its immense potential, but also raises a significant flag about its risks to financial stability.
AI is absolutely a double-edged sword in finance, and the BIS is acutely aware of that. The report notes AI's growing influence on economic systems has pros and cons, offering efficiency gains but also posing risks to financial stability if not properly managed.
Efficiency versus risk. What kind of risks?
Well, this isn't just theoretical. In a highly interconnected financial system, algorithmic trading driven by AI could accelerate market shocks, potentially turning a small dip into a flash crash faster than human traders could react.
Machines reacting faster than people can manage.
Right. There's also the risk of model monoculture. If too many financial institutions rely on the same AI models, they might all react in similar ways to a given market signal, creating systemic vulnerabilities or unintended collective actions. Herd behavior on steroids.
Everyone rushes for the exit at the same time, driven by the same algorithm.
Potentially. The BIS stresses the urgent need for governance frameworks to harness AI's benefits while mitigating its risks. This means developing robust oversight, ethical guidelines, and ensuring explainability in AI models used for critical financial decisions. You need to understand why the AI made a certain decision.
That seems crucial, but maybe difficult with complex AI.
It's a huge challenge. For policymakers, it's a race to stay ahead of the curve, which is difficult given AI's rapid evolution.
And for the listener.
For you, AI could lead to more efficient, personalized financial services in the future, better loan processing, tailored investment advice. But it also potentially exposes you to new, complex, and rapidly propagating risks if not carefully contained and regulated.
So we've laid out the complex challenges, from eroding trust and persistent inflation to the hidden risks of non-bank financial institutions and the double-edged sword of digital finance. A lot to worry about.
A complex picture for sure.
But the BIS doesn't just sound the alarm. Crucially, it offers a detailed roadmap for stability. First, and perhaps most fundamentally, is the need to rebuild trust and strengthen policy frameworks.
This point is foundational for everything else. Augustine Carstens emphasizes public policy is crucial as a stabilizing force. Policymakers must act decisively on multiple fronts to ensure price stability and promote sustainable economic growth while preserving economic and financial stability.
So policy as the anchor in the storm.
Pretty much. The report is clear. Policy needs to be conducted with credible frameworks that deliver reasonable outcomes in a broad range of scenarios. This means policymakers must set clear targets,
Be predictable.
clearly explain their actions and decisions to the public, and be held accountable. Transparency and accountability.
Makes sense.
The BIS stresses that trust and policy effectiveness reinforce each other, forming a virtuous circle. Trust makes policy work better, and effective policy builds trust.
But it can go the other way, too.
That's the critical warning. The dynamic can also work in reverse. Threats to central bank independence or drastic changes in international policies risk not only failing to achieve their stated objectives, but also undermining the effectiveness of future policy measures. If trust is lost, policy loses its power.
And why does this matter to you, the listener?
For you, this predictability and transparency in policy affect everything from long-term investment decisions to how you plan your retirement savings. If you can trust the direction of economic policy, you can make more informed and confident financial choices. Uncertainty makes planning much harder.
That really sounds like a strong plea for consistency and clarity, especially from central banks, given the political pressures they sometimes face.
It absolutely is. Carsten's various speeches like trust in public policies and trust in macroeconomic stability,
Yeah.
a virtuous circle, underscore this deep conviction. In an era where trust in institutions is declining globally, the very effectiveness of policy is at stake,
Get the trust right, and the rest becomes easier.
or at least more manageable. When the public understands and trusts the central bank's commitment to price stability, their inflation expectations are more likely to remain anchored, making the central bank's job significantly easier. Without that trust, the policy tools become blunted and less effective.
Okay, so trust is paramount. Another fundamental pillar of the stability is addressing long-term economic challenges through structural reforms. This isn't just about tweaking interest rates, is it?
No, this goes deeper. It's about deep-seated, often politically difficult changes. Structural reforms are key to addressing declining productivity growth and improving supply flexibility,
Making the economy more efficient and adaptable.
which is crucial for countering the negative impacts of trade fragmentation we discussed earlier. The report states structural policy needs to address low productivity growth and improve the ability of the economy to scale up production and reallocate resources. This is about making economies inherently more resilient and efficient at a fundamental level.
Like fixing the foundations rather than just painting the walls?
Good analogy.
Yeah.
For instance, the BIS suggests removal of barriers to trade, both within and across borders, would help offset the damage from the ongoing trade conflict.
Pushing back against protectionism.
Yes. And the BIS makes it clear that tariffs, while sometimes politically popular, are often ineffective instruments for reducing trade deficits
Why ineffective?
because they depress gross trade flows but barely move net balances. This is a crucial insight. Tariffs can hurt overall trade and supply chains, damage global growth,
Create friction.
but they don't effectively fix deeper trade imbalances, which are driven by broader macroeconomic factors like national savings rates and investment levels.
So even if they're politically attractive, tariffs don't truly solve the underlying problem and can actually cause more harm to the broader economy.
That's the BIS's clear assessment. They point out, for example, that manufacturing employment in many advanced economies often drops faster than manufacturing GDP suggests.
Meaning?
Suggesting automation, rather than just trade deficits, is a major driver of those job shifts. So blaming trade alone might miss the bigger picture.
So what should be done?
The focus, therefore, should be on enhancing competitiveness, increasing smart public investment, like the German government's recent announcement of a large infrastructure fund, which the BIS notes streamlining regulations and supporting displaced workers with retraining and better safety nets.
Longer-term solutions.
Exactly. These reforms, though challenging and sometimes slow, ultimately benefit you through improved living standards, better public services, and a more resilient economy that is less prone to sudden, destabilizing shocks.
Alongside these structural changes, the report also offers clear guidance for monetary and fiscal policy, which are often the levers we hear about most in the news.
Right, the day-to-day policy tools. Here the message is clear and somewhat traditional, but with new urgency. Central banks are urged to continue prioritizing price stability.
Keep inflation down.
Augustine Carstens calls it the cornerstone for sustainable growth because it directly preserves the value of your hard-earned money.
Protects purchasing power.
Precisely. Monetary policy should adopt a symmetric approach to inflation targeting, meaning central banks need to respond forcefully to both inflation significantly below target and significantly above target.
Not just fight high inflation, but low inflation too, if needed.
Right. They need to be agile and responsive, with the policy interest rate remaining the primary instrument. And crucially, the use of balance sheet instruments like quantitative easing or QE should be reserved with caution, and primarily for crisis times.
Less reliance on QE in normal times.
That's the strong implication. It suggests less reliance on unconventional tools outside of genuine emergencies, perhaps due to concerns about their side effects or exit difficulties.
So they're essentially saying central banks need to stay hyper-focused on inflation and be nimble using their main tool, the interest rate, without over-relying on less conventional tools that can create new risks.
That sums it up well. On the fiscal side, government spending and taxes, governments must ensure debt sustainability and restore the space for supporting the economy when needed.
Get the debt under control.
Yes. This means countries with large fiscal deficits must pursue fiscal consolidation, which means reducing deficits and debt over time. Ideally, this should be done in a gradual way and designed to enhance long-term supply potential. So smart cuts or taxes, not just austerity that hurts growth.
Finding that balance.
It's a very delicate balancing act for central banks, made even harder by persistent supply shocks and those elevated inflation expectations we talked about. For you, fiscal consolidation reducing debt could mean difficult choices about public services, taxes, or government investment in the near term.
Trade-offs.
Always trade-offs. But as presented by the BIS is necessary for long-term stability and rebuilding that buffer for future crises. The report highlights contrasting situations, like Brazil's central bank raising rates rapidly in response to de-anchoring inflation expectations, versus China's People's Bank adjusting to a moderately loose stance, showing the diverse challenges globally.
Different countries, different problems, but the core principles apply.
That's the idea.
Finally, the BIS highlights the urgent need to address vulnerabilities in the financial system itself, particularly those outside traditional banking. This brings us back to the NBFIs we discussed earlier.
Yes, closing the regulatory gaps. The BIS calls for regulatory frameworks to be updated to effectively address risks in the growing NBFI sector. They emphasize ensuring the consistent implementation of Basel III across jurisdictions for traditional banks,
Finish the job on bank regulation.
but also advocate for a more holistic approach. This means applying consistent regulatory frameworks to financial intermediaries that pose similar risks to financial stability. They call this congruent regulation.
Congruent regulation.
Meaning, think of it this way. If an institution acts like a bank, takes on bank-like risks like maturity transformation or high leverage, and could cause bank-like problems for the financial system if it fails, it should be regulated in a way that's congruent or consistent with how banks are regulated for those specific risks, regardless of what it's called.
So if it walks like a duck and quacks like a duck.
It should be regulated like a duck, at least for the duck-like risks it poses, even if it calls itself something else. For example, the Archegos Capital Management collapse back in March 2021 starkly illustrated vulnerabilities between traditional banks and private markets, as banks faced significant losses due to their exposures to this less regulated entity.
A painful lesson in interconnectedness.
Indeed. This same activity, same risk, same regulatory outcomes approach extends directly to stablecoins and crypto assets as well.
Applying the same logic there.
Yes. The most pressing issues related to these digital assets, from the BIS's perspective, are integrity and financial crime, including adherence to anti-money laundering and counterterrorism financing requirements, and the quality and transparency of the assets backing stablecoins. Is the backing really there and safe?
Verifying the stable in stablecoin.
Exactly. The BIS warns that without adequate oversight, the next financial stress episode could originate from these less regulated corners. This kind of congruent regulation is crucial to protect you from cascading financial crises originating in the opaque, less regulated parts of the market.
Building resilience everywhere, not just in the banks.
That's the goal. Building resilience across the entire financial ecosystem, not just in traditional banking, which is already quite robust thanks to Basel III.
The BIS report also strongly emphasizes the imperative of international cooperation, especially given the fragmented world we're seeing. Seems harder than ever, maybe.
It's certainly challenging, but the BIS argues it's non-negotiable. They see their role as a hub for fostering dialogue among central banks as more critical than ever.
A place for central bankers to talk?
And coordinate. Policymakers were urged to adopt a more coordinated response, particularly given the faster global transmission of financial conditions and increasing divergence in fiscal positions across economies. What happens in one major economy now affects others very quickly.
Spillovers are faster and bigger now.
Right. And global challenges like climate change, mentioned as a driver of future shocks, and the geopolitical tensions we discussed earlier, simply cannot be effectively solved by individual countries acting alone. Policy fragmentation could exacerbate global shocks unless there is cooperation on financial regulation, debt management, and cross-border capital flows.
So if countries just keep acting purely in their own perceived self-interest, it could actually make everything worse for everyone, like a prisoner's dilemma on a global scale.
Precisely. The lack of collective economic management means we face a heightened risk of unaddressed global issues, which had then spill over into national economies, harming everyone.
Even on political friction, the report acknowledgeth it.
Yes. Augustin Carstens, when asked about political pressures on central banks, like criticisms of Fed Chair Powell, once responded with a profound insight. It is to be expected at certain points in time that there will be friction. It is almost by design.
Meaning conflict is built into the system sometimes.
It speaks to the inherent tension in an interdependent world where economic policy has distributional effects. But cooperation is still vital. Realizing the full potential of tokenization, for example, also requires central banks and public authorities to work together closely to establish common standards and legal certainty. Without this cooperation, the roadmap for stability becomes far harder, if not impossible, to navigate. #outro.
So as we've unpacked today, the Bank for International Settlements is sounding a powerful clarion call. A serious warning about the state of our global economy, but crucially, also a clear, actionable roadmap.
Warning and a way forward.
Exactly. This isn't just abstract economics confined to boardrooms. It's about the very foundations of our financial world and how it directly impacts your daily life, your investments, and your future.
If we connect this to the bigger picture, the BIS report is a powerful reminder that while markets may appear resilient on the surface, sometimes surprisingly so, profound underlying fragilities demand our vigilance. This raises, I think, an important question for all of us. In a world where policy failures and the erosion of institutional trust are diminishing our economic resilience, are we truly prepared?
Prepared for what?
Prepared for a future where traditional buffers like fiscal space or anchored inflation expectations are weaker and every soft landing hope might just give way to much harder truths? Are we ready for a bumpier ride?
That's a powerful thought to leave you with, isn't it? Are we ready for harder truths? What stood out to you from this deep dive into the BIS's warnings and wisdom? Keep gigging, keep learning, and we'll be here to help you unpack it all next time.